Index investing or passive investing has grown more popular with investors. Even Warren Buffett touts the benefits of owning an entire index like the S&P 500 over the long term. An example of an index tracking ETF is BMO's S&P 500 Index ETF. It's the largest ETF in Canada that tracks this well-recognized and popular index. It provides exposure to the returns of the market cap weighted S&P 500 index at a low cost with a management fee of just 0.08%. This broad market ETF makes for an efficient building block in a portfolio, saving you time and effort while mitigating single stock risk. If you're looking for exposure to the largest and most liquid public companies in the United States, this ETF delivers an easy-to-use solution and instant diversification. Commissions and management fees and expenses all may be associated with investments in exchange-traded funds. Please read the ETF facts or prospectus of the BMO ETFs before investing.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 116. As always, joined by the three amigos. We got Rich Diaz of PGM Global and Keith Dicker, IceCap Asset Management. Welcome back to the show, gentlemen. Boomer.
Ho, ho, ho. How was Christmas, lads? How was it?
Good, man. Did you get a new Patagonia sweater there?
Yeah, I upgraded a few pieces, but my...
A few pieces. Those aren't cheap.
well, what I upgraded on... I'm a big T-shirt guy, hey? Because, you know, they fit well. And but Rich, my T-shirts, like once a year, I get this huge order from Old Navy. You know, the $5 themed shirts you can get.
Wow, you're right up my alley.
Yeah, I know, man. Yeah. So for Christmas, I probably got at least a dozen Old Navy T-shirts. Nice. And I was like a kid on Christmas morning with them.
Do you rock colors?
It's different themes on them. Usually it's a mountain climbing theme or, you know.
Oh, you put prints on your shirts.
No, you buy them that way, Steve. You go to the website and you just buy the
You gotta
shirts.
go like plain black or plain white. You can't mess it up. Just simple. And nobody even knows it's a $5 shirt. It's just a black T-shirt. Clean, simple.
That works for some people. Like for the brooding guy in Kitsilano, maybe it works. I like a nice little print on front. What about you, Rich? What do you think about that? What is your T-shirt strategy?
My T-shirt strategy, it's kind of in between the two you boys. I like a nice plain tee, but I like a T-shirt that has a message like "Say no to CBDC" or "Crude oil is super useful." I like to have a little bit of an important message on my T-shirts every now and again. But you know, I'm an equal opportunity T-shirt guy. But no, it was a good Christmas. Ate way too much food. Watched too much TV. It was lovely. I got a book, which I'm pretty happy about. So
you got a book.
Got a couple books.
Drum roll. What is it?
It was called Normal People. It was like it was like a shortlisted for a Booker Prize a little while ago.
Okay.
I also got some snazzy headphones. It was all right. It was a good haul this year. Good haul.
There you go. Well, in case you didn't know, it's a slow news week. We're talking about T-shirts here.
That's right.
Yeah, but you know, if you're going on a date, Rich, you got to go like plain black T-shirt. No.
Yeah, you think? Show my guns. I don't know.
Like a slim fit.
I like to be a little bit more smart casual on a date. But anyway, come on. Enough of my dating life. Please.
All right. Well,
relax thereof.
Rich's dating life, my T-shirt life. And by the way, to be clear, I do like the solid tee because, you know, one of the greatest TV characters of all time always wore either all white or black T-shirt.
Who's that? The Fonz?
Yeah, the Fonz. Arthur Fonzarelli.
Yeah.
He was a good guy. He was
very
good.
predictable.
Yeah.
Anyways,
so,
we'll, you know, this
predictable. Steve, speaking of predictable, what do you have lined up for us this week?
We've got, you know, again, it was a bit of a slower news week as one should expect, but we wanted to keep the consistency going with the Loonie Hour here. We've yet to miss a week over 2 years of recording this podcast. So we've got Pierre Poilievre put out a video called the Canada's Detonation video. We kind of want to unpack that, not so much from a political standpoint of, we just want to discuss the validity of the video, and because there's all these people going back and forth. As soon as the video dropped, of course, like this is the brilliant thing from a marketing perspective is you drop the video and then like people, whether they agree with it or disagree with it, they basically start discussing the video. So this guy gets free publicity. It's smart marketing, because as soon as he drops it, right, like Chrystia Freeland goes to her Twitter, starts tweeting saying, "Oh, this is stupid video. We've got no debt problem. Blah 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 blah." All these econs are out there on Twitter sharing their views of the video, and so we kind of wanted to share the Loonie Hour's perspective. So we're gonna get into that. We've got some bond market volatility again as we head into the new year. We got some important data on gasoline for your vehicles, as we discussed in the EV markets last week, and U.S. pending home sales, things like that nature. But just for everyone's scheduling purposes, we won't be missing next week either. So next week we'll be recording just after the new year. We'll probably put together some predictions, maybe some outlook, some forecasts. We'll have some fun with it, because I think really, financial markets, Keith, really aren't going to start getting interesting until mid-January. People will get back from holidays.
I think Jan 8th week, like the second week, will maybe even on the second, really figure out what's happening. Because the last 2 weeks, and people made a lot of money the last 2 weeks, and it's always, hey, this is awesome, and people are linear thinking. But the liquidity and market moves have really been amplified the last 2 weeks. So I'm not trying to be positive or negative with it. It's just, it is what it is. And we'll get a much better gauge for where the world is headed into January as we go there.
Basically just saying be careful about extrapolating at this point.
So liquidity is also known as like volumes. So literally how many shares or bonds or how much currency is being is traded on the exchanges every day. And you can actually see how the volumes sort of dry up over this period because people are in food comas and on their couch watching football, or maybe they're on the beach somewhere, or yeah. So
yeah, it makes sense. So getting back full circle to Pierre Poilievre's video again. So I believe this is video 1 and supposedly what is a series to come. And so, basically he put up this video. I think it's, 5-10 minutes long. It's on Twitter, so you can go and check it out there. But basically, it's 15 minutes long. And basically it talks about Canada's debt issues. It says that, Canada is one of the largest, debt to GDP ratios in the G20. And he's basically warning that, excessive fiscal spending at the federal government level does risk a debt crisis. And so that's basically the premise of the video. And he kind of walks through, the Bank of Canada holding rates at 0 and, highlights household debt, corporate debt, public debt. And I think specifically he was really trying to, obviously, again, from a political lens, trying to frame this as the federal government is being reckless and they are spending a lot of money, and that's creating excessive debt issues on top of the already high debt level. So Rich, I don't know if you want to unpack a little bit further. I've got my thoughts. I'm sure Keith's got his thoughts. So we'll kind of chime in here, but I know you want to take first swing at this.
Yeah, sure. Well, I mean, in general, I think it was actually, there's a couple, I have loads of thoughts and we'll get back. Well, I know we'll go back and forth, but I think in general, I don't think it was as big a criticism on the federal government as you might expect from the opposition party and someone who has been hypercritical. I think his general overriding point is that Canada has an incredible amount of debt, and they do, and they have high debt levels relative to their own economy. So he uses GDP, and we'll unpack that number in a second, but he also uses relative to other countries. And I think it was actually, I'll get into the negatives in a second of what I thought, but I think just in general, I don't know how you guys felt, but it was just more basically an educational video of sort of what the negative impacts of having so much debt might be for an economy. And so that was just my first blush. I don't think it was necessarily it was as critical, let's say, of the government as I think it could have been. I don't know, Steve, if you thought that was right.
Yeah, it was kind of like almost like it was the same sort of idea or framework of his housing video that he put out maybe 3 weeks ago, which again also went viral and had mainstream media picking it up and discussing it. And the housing one, for example, like someone that, like myself, that watched it, I would agree that 85% of the video I think was very factual, and I would say it was maybe 15% of that video where I was like, well, I don't know if I agree with that. I think there's some more nuances here that are being left out or not explained in detail. And I think similar to his debt video this week, it was like I think most of it was accurate. I think that coming into this, though, what I'll say is the private debt loads are really ultimately the biggest precursor to financial crises. So there's a lot of good books out there that you can go read. Professor Steve Keen, who I've interviewed several times, has written a couple good books on debt crises. I think Richard Werner is another one of them. So there's a couple really good people that have highlighted. He highlights Kenneth Rogoff as well.
Yeah, Reinhardt and Rogoff.
Yeah, this time is different. I mean, that's like kind of like the book on debt crises. So like, I mean, they're kind of the experts on these. And if you read that book, it will tell you that most debt crises are done through the private sector, right? So, and we've had incredible buildups in household debt, particularly in Canada, right? And that's really based on excessive borrowing against real estate.
Mm-hmm.
Right. And so because in 2008, 2009, Canadian households did not delever their balance sheets like, for example, the US did. And so household debt to GDP just kind of continued to grow and has continued to grow as house prices have grown.
Yeah.
So it's funny because like there was I saw one of the economists, and I actually kind of like this economist, but this is where I think like the mainstream kind of gets it wrong, Keith, is they say, oh, well, household debt to GDP, yeah, it's really, really high in Canada. I think it's like second worst in the G20. It's really high. But they say, but you got to look at the assets.
Yeah.
But it's kind of a circular problem, is it not? I mean, the more that you can borrow, the more you sort of expand the asset price, right? It's like, yes, household debt is going up, so house prices are going up along with it. But that's why prices are going up, is because you can borrow, right? If you can only borrow 3 times your income, it's probably not going to go up as much as if you can borrow 7 times your income. So of course, your asset's going to go up if everyone starts borrowing 7 times their income. But Keith, I don't know if you have any initial thoughts.
So first of all, for this conversation, I think everyone involved with it, to just remove your political lens or bias or whatever, right? That's what you have to do, because everything's just been so magnified these days. We know why this has come out. I mean, it is from a political perspective, and then the immediate response to it is extremely political as well. So what we strongly suggest to everyone, just eliminate that view. Instead, look at it as this is such an incredibly important conversation for not only for Canadians to have, but for the Europeans to have, the Americans, the Japanese, the Chinese. Everyone needs to have this conversation. And it can only start from the ground up. So something like, where we're discussing on the podcast, and maybe families are going to be talking about it over lunch or dinner or whatever, whatever they're doing. So that's the first thing with this. And that's actually good news, because most of these crises, people only realize it was a crisis or it was a problem with hindsight, after it's happened. So again, I think people know my view on this. I've been talking about it for a while, and I thought the video hit on a number of really good points. And the main one specifically, people have had private conversations with me, I'll frequently talk or explain the narrative with interest rates and the movement in rates. And, you most frequently in this video, they reference 1981 or 82 when rates peaked. Then they kept going down. That allowed debt to accumulate. So, we were joking beforehand, three of us, about, what constitutes experience in the economic and investment world these days. We'll joke, people say, oh, they have 10 years experience or 15 years experience. And even if you have 15 years experience today, it brings you back to the housing crisis, like 08, 09. But we've had this 40-year period with rates always going lower and lower and lower. And Steve, what has that enabled household and governments to do?
Borrow lots of money.
Borrow, baby. Borrow, baby, borrow. That's what it is. So my first thoughts on this is, it's a conversation we should all have, and it's a positive conversation. And then if anyone listening to this who's in the power to get this going, again, it's just, we brought this up before, and it's shocking and embarrassing. Our education system is financially illiterate. Financial literacy has to start in primary and go through high school, middle school, senior school, universities, and everything. And then we're still going to hit these cycles along the way, but at least we're going to have, it take a generation to do this, but at least more and more people will be aware of what debt is. And see, because you mentioned that net debt and net assets and everything, and you're absolutely right. By borrowing more, the assets can rise if you get appreciation in that asset. The big question is, if the asset gets chopped in half, then that's when the debt bubble breaks.
Well,
that's the initial.
Like, we already know it in the housing sector, right? It's like, okay, well, I can tell you maybe one of the most common scenarios here. This is like everyday life. I'm in particular in Vancouver and Toronto, where values have gone up tremendously over the last 10 years. So one of the most common things was, you're entering the housing market, you're on the housing ladder. You would buy, let's say, a condo, you'd live in it for 5-6 years. And then when you're ready to upsize to a house because your family's growing, you'd sell the condo, you'd maybe have a little bit of equity gain, and you'd upsize to your house. What we've seen over the last 10 plus years is people have said, whoa, a condo I bought has doubled. So I don't want to or need to sell it to climb the ladder. Why don't I just refinance it? Take a couple $100,000 of equity out of it, right? It's free money, basically. It's house money. And I'll use that, refinance that equity as my down payment to buy the house that I want to move into. So people that otherwise maybe wouldn't have become landlords have become landlords because there's been this massive price growth. And again, that's only largely, I would say, been enabled through low interest rates, which have allowed people to borrow more money, house prices to go up, and to obviously be able to refinance. Like, you're probably not doing that. I can tell you, people aren't doing that, certainly not to that extent today, when you're borrowing mortgage rates at, say, 6% as opposed to 2%. So, and I think the household debt picture, I used to talk about this a lot on my real estate blog when, I first started sort of going more public. Well, in 2016 was really about Canada's household debt problem. And everyone just it's an interesting topic of conversation, but people largely, in my experience, have ignored it because it's been 40 years or 35 years or whatever of an up market in Canadian housing. And, this debt bubble has sort of been brewing, and household debt to GDP continues to kind of go up and up and up, but nothing has blown up, and it's been, decades, right? So people don't really think about it. They don't really perceive the risks. But it doesn't mean the risks, in my opinion, have gone away. It's still there. It's still a problem.
So bringing sort of what both you guys were talking about is one is sort of that refinancing piece. And that refinancing piece works when two things are present, is when house prices are going up. So you've got sort of froth, you've got that speculative fervor, you've got sort of demand or supply demand mismatch, and you've got interest rates that are falling or negative. So there are different formulas for how you might calculate sort of the intrinsic value or the value of a particular asset. And usually you do sort of future cash flows divided by your discount rate with some kind of adjustment for time and the period over which you might be paying that payment. And so the lower that your discount rate goes, you've got your numerator and denominator. The lower that denominator goes, the higher your intrinsic value goes. So you got the stuff on the left and the stuff on the right of the equation. And now it sounds a bit boring, but that is fundamentally what we are dealing with. And so to bring it towards to sort of wrap it into what Keith was saying is like when that discount rate is continually going down, or yes, you guys have heard me say for a long time, was negative in real terms, which is a crime against financial and humanity. When that R piece, your discount rate, stops falling and starts rising, your intrinsic, just mathematically, even though your future cash flows, right, your numerator is okay. If your denominator starts rising, that's on this side of the equation, your intrinsic value will, all things being equal, start to fall. And so that's why I push back against this sort of debt versus assets piece. Yes, our debt, one of the criticisms of the video is, oh yeah, but our assets are obviously much, much higher. And it's like, yes, our assets are high because our interest rates have been very, very low, right? That's literally like a kind of a tautology in a sense. And so if you have a situation where our interest rates cannot decline anymore, or your future cash flows are stagnant, right? So you got your numerator, denominator, then your asset piece is going to start either be stagnant or fall, but the nominal value of your debt remains. And so you can have a situation where your assets aren't necessarily, they're not worth what you think they're paid for. And we know this is, we see examples of this all the time. Think of commercial real estate, where you thought there was an asset that was just sold 10 years ago. Asset was sold for $280 billion, and it was just sold to a real estate company out of the UK for $26 billion. So you have a situation where sometimes you do have asset impairments, and yet you still need to pay for that debt. And this reminds us, of course, of a conversation we've talked about balance sheet recessions, but maybe we'll get into that later.
Yeah,
I mean,
well, there's some other good charts out there. Ben Rabideau has been one of the better ones of putting this out, I think, consistently every single year, which is really a chart on the renewal, the renewal gap, he calls it, basically, in which just shows like, okay, Canadians that are, borrowing on a 5-year fixed mortgage, this year, what are most Canadians going to renew at? Is it higher or lower? And it's been like lower for like 20 or 30 years. And like every time it kind of was like higher, it would be higher for like maybe it'd be a little bit higher for a year and then it would drop back down. So we're going to get this a better understanding. Not only 2023 was a higher renewal gap, 2024 is going to be higher, and we'll see where 2025 is. So I think Canadians are in for a bit of a challenge here over the next year or two. But I think the one thing that I wanted to point out, so Chrystia Freeland, again, to Keith's point, try to keep your political biases out of this to the best of your ability, is, so she commented on the video and she said, our responsible economic plan allows us to make crucial investments in Canadians backed by a AAA credit rating and the lowest debt to GDP ratio in the G7. And so she basically is saying this video is fake news, or I don't know, whatever you want to call it. But so she's talking about lowest debt to GDP ratio in the G7. I'm assuming that she's discussing or pointing to public debt.
She's talking about federal. She's talking about federal government debt.
Yes,
which is extreme. Like that's extremely misleading, because no one. And so you say, Rich, why could you be so punchy about this? It's because when you Google, again, don't take my word for it. When you Google general government debt, one of the first two links that will come up is the IMF, and the IMF calculates all this stuff, and it's always general government debt. And so what that means is you're not allowed to just parse out local stuff or state or whatever, provincial or municipal. They aggregate that debt and they call it general government debt. And for Canada, general government debt is very, very, very high. And we know this. And so that's why it's very misleading when she says, oh, Canada's government debt is the lowest in the G7. First of all, we know that the G7 comparison is absolutely bogus. We've talked about that before. But more importantly is that general government piece. So Canada's debt to GDP is in the hundreds. Again, it depends on who you're looking, how you calculate or when. 100, 105% debt to GDP. And it is as high as anyone in the G7 and one of the highest in the OECD. Sorry, Steve.
I'm assuming that she's pointing that out because that number that she's highlighting is excluding provincial debt.
Yeah, but she's saying it because it's low. If you trust me, if it was the other way around or something, she would definitely, Yeah, that's the point, right? It's
So
clear.
let's bring the. I mean, it's a really good point, and that's the response. Again, from a political perspective, they have to come out with something like that. I mean, we're at the end of an election cycle almost, so that would be expected. But again, we keep going back to what's important here. Maybe three of us would do our own little straw poll, I guess you call it, or
Sure.
we'll do hands up. How's that? So everyone might not see how Steve votes. First of all, is this a problem? Like hands up, is this a serious problem, or is it just, again, like part of the election cycle conversation? So hands up if you think it is a serious problem.
If debt in full stop is a problem.
Correct.
Yes, my hand is up.
Yeah.
Okay, so that's three. Actually, Rich voted twice. Everyone, he put two hands up. So we got four votes for this being a serious problem. So I think next, then, I think most people listening to this, the question is, okay, hey, when does this happen, right? And the shorter answer is, we don't know. We don't. Steve was looking at this back in 2015, and I know a lot of people
could easily go another 10 years easily.
I agree.
I think that's exaggerating it a little bit.
No, but Steve's point is fair, Steve's point is maybe not 10, but I think Steve's point, if I may, is fair in the sense that, people have been talking about the sovereign debt problem for a number of years, and we have yet to feel any kind of pain. And I think the mistake that people who would dismiss this as a point of worthy discussion is that just because we haven't felt the pain doesn't mean it's not a real problem.
So my pushback with that view is that it hasn't happened yet, because we were at zero rates with QE for everyone around the world for over a decade. And really, we've had, 18 months now of yield curve stress. So I think that's the period we're looking at. Do you know what I mean? So 18 months, that's what we should now, maybe it's 22 months, right? When do rates start going up?
No, I think that's a very fair point. That's a very fair point.
And like back to my, observation again, people say, oh, I've been around for 10 years. I know everything. And like, I'm a boomer. I've been around for a long time, and I haven't seen all the bad stuff that was happening when rates were going higher, because, nobody's working anymore that saw that. So that's why we have the financial historians out there. But again, we've had this 18, 22, 24-month period where it's becoming a real struggle here. So the question is, hey, is it a debt bomb? And based on the amount of debt that's out there, it is a bomb. And then the next question is, how long is the fuse, and will it detonate, or will it be, one of those old black and white movies where everyone's stomping on the fuse trying to get it out? And actually, no, it's the animated ones for Disney. Then at the very end, somebody's used a pair of scissors and cut it.
Yeah.
How do we cut it?
We call it a damp squib.
A damp squid.
Do you know what a damp squib is? A damp squib is when you have a squib is like, it's like when you're trying to light a bomb, and you have like the little piece that's like the like blow that sets off the fuse to blow up the bomb. It's called a squib. And if you have a damp squib, it means the bomb doesn't go off. The fuse goes all the way to the end, and it goes and it pizzles out.
Maybe that's what I think that's really called a debt. That's called a debt restructuring, though, if you think about it. So the damp squib, is that what we're going to call it?
Yeah, with a B. Yeah.
Yeah. So I mean, but the other thing people are wanting to know, like, okay, what do you do? How do you protect yourself during this, if it's going to happen, or if the probability, like what? So I have in my mind, like, what are you going to look for first to see if it's accelerating, or as Steve said, maybe it just hangs out for a lot longer. What are your thoughts, Steve?
Well, I mean, I think like just reading some of the rebuttals online, again, not like, and I'm talking like the rebuttals from mostly a lot of them journalists, some of them economists, and mostly like, university type economists. I'm not talking like, hey, economists, I work at a Wall Street bank, and I'm looking at financial markets every day. I'm talking about just like the other type of economist, and
you mean podcasters.
Yeah, exactly. And the rebuttal right now, and it's like, oh man, like this is hard to read, is, oh well, again, we've got a AAA
sovereign rating, AAA credit rating.
That's a
And
bullshit answer. Carry on.
and number two is, if we had a debt problem, if Canada really, if the world was really concerned about Canada's debt problem, our bond yields wouldn't be trading, neck and neck with the US. We would just, right? We'd be paying up the nose to borrow money, and we're not. So there's no problem.
Another very, very superficial rebuttal. So the first rebuttal was our credit rating is AAA rating, triple rated. I would submit to you the movie The Big Short, where all that MBS was AAA rated. And then the second rebuttal is that the spreads are tight, and that, okay, again, a very superficial rebuttal. In 2007, the Italian to German 10-year bond yield spread was 25 basis points, and within 3 years, it was 500. So just,
So Rich is right. Let's think, most people remember, let's just call it The Big Short. That's what everyone has in their mind. And with hindsight, it was incredibly obvious, very likely this event would happen, right? That's what most people now would say. Yeah, of course, everyone saw it coming. If that's the case, then why didn't markets move in 07 or 06? Or why did it only start in Jan or Feb of 08, I think, when Bear Stearns had the problem? You know what I mean? So for this, first of all, credit ratings, it's either, are you allowed to say they're bought and paid for? Can you say that, Rich?
Yeah, of course. That's what they are. They are bought and paid for. They're not to be taken seriously.
But they're not proactive with things, right? They're really, it's a result of something going on, and they're relative and everything. And the same thing with the bond market. So a bond market is only going to start to react, it's if you can smell it, and there's fire coming out of the house, now we got to go. And as Steve, as you pointed out, that's not happening right now. It's just the conditions are there for potentially, the fire to start. So with those rebuttals, I'm telling you, the credit rating is going to be the last thing to change. So don't manage your wealth by relying on S&P or Moody's or, God forbid, the Dominion Bond Rating Service or Fitch. I think I got 4 of them, right? But again, you have to watch the market for where they're going.
Watch The Big Short. The lady at is it Moody's? They asked why she hasn't remarked the mortgage-backed securities, or is it? Yeah,
it's kind of funny because then she had eye surgery, so she had the big dark glasses on and everything. But that's Hollywood, right? That's Hollywood. So what the first thing that we need to look for here, hey, is this happening? So you have financial market data, and we talk about that every week, right? It's, Rich gets excited about it when, maybe his date doesn't, but you got to look for those things. Well, you have to answer yourself this, okay? First of all, I'll make a statement, and I know I'm 100% correct. You guys can tell me, yeah, you're not totally correct. Governments will always be reactive to this event. They, by definition, they cannot be proactive. So let's just say the Canadian government, they want to be proactive because, hey, we have this enormous debt problem and everything. They have to lay off half the government workforce, raise taxes, stop spending, and all that. And that ain't going to happen in a normal cycle. It's clearly not going to happen in the year before the the election cycle is coming up. So next, you always say, okay, well, there's a market that's smarter than everyone else, and that's the private sector. So you have to start watching, are there layoffs or hirings? What's happening? So that's why the jobs number is so important. We look at it every month. And even those numbers, a lot of them are smooth, they're seasonally adjusted, is at the household level, or at the establishment level. But you got to start looking for layoffs, and specifically in the financial sector. Because those are the guys that can smell it. They can smell it coming. And there's already been a lot of layoffs in the financial sector coming up. So as we go into 24 for everyone, just start reading the papers, listening to the news and things, and say, okay, are big companies hiring or firing? What are they doing? Because they will get lean and mean before governments and before households, right? So governments are the last ones to do it, but watch the private sector first.
Yeah. So, Keith, to your point, global banks, this is from the Financial Post, global banks eliminated more than 60,000 jobs in 2023, marking one of the heaviest years for cuts since the financial crisis, and reversing much of their hiring that emerged from the pandemic. So,
But can I just talk about some other worthy criticisms that I think were missed of that note? Because I think that this is that tells you that these people, in my view, are political and not being analytical about sort of their criticisms in Pierre Poilievre's thing. Number one, I think the number's wrong. So the first line of the whole video, he says 350 times, 3.5 times GDP, and then I think he's repeated again at one point, says the 350% of GDP. I think that number's too high, and that's nitpicking. So forgive me, but the numbers matter. The BIS has it about 307, and the IMF is much closer to that 300 mark. Now, however, that is absolutely one of the higher figures in the world. I think you have places like Hong Kong, which is sort of a financial anomaly. You have a Singapore's, and then you have Japan, which is its own thing. So you're not an exactly great company, but that would be sort of one of my criticisms. And the other two, I think that they sort of missed is like, when you have population growth 3% a year, if you just continue to have that kind of insane population growth, and of course the inflation that comes along with it, what you effectively have is nominal GDP growth that is sort of much higher than you have had over the last several years. And you can have a situation where, because you have a little bit of nominal GDP growth, again, it's the whole numerator versus denominator thing. You have, so it's, debt to GDP. Well, if your nominal GDP starts rising, again, because of inflation, I'm not saying that's good for people, I'm just saying that's the reality of it, then you have a situation where those debt numbers aren't as bad as they might seem at first blush. So those are two my sort of criticisms that I think that would be worthy right off the top.
So
Yeah.
I want to jump ahead of Steve, it seems.
Go ahead, fire away.
Yeah. Okay.
Seniority.
Thanks, man. We do have to come back and talk about the Canadian specific debt experience we had in the early O's. I'm going to say it was 02 to 04. I'm just guessing the time frame here by a year or two. We have to do that. And then the other thing to consider on top of all this as well, something we talk about a lot, is that this is not a Canadian specific story.
Right.
You just touched on it then, Rich. Now, this is a global problem. The entire world has binged off a 40-year cycle of rates going lower and lower and lower, flatline, zero, negative, QE, and all that. So again, like this Canadian challenge that we could have coming up, it's likely it could be ignited by someone outside of Canada. And then, much like the Asian currency crisis back in 97, 98, it'll then come ashore here. So don't think it's Canadian specific, because if it's just a Canadian problem, we could still experience it. And if we do, it'll be a short-lived experience. Because of global trade, you get a weaker currency, you sell stuff and you recover from it. And foreign investors, they're not hurting. Yeah, absolutely. Let's invest, $500 million in like a new EV plant in Windsor or something like that. But do you see what I mean, though? If it's just a Canadian problem, if it happens, it'll be short-lived. The challenge today is that this is largely a global problem. So therefore, it could turn into something, that's a little bit longer than what we would want to have. Okay, Steve, I'll give you 18 seconds before we come back to the Canadian story.
That's all I need. I think that it kind of comes to this point, though, again, that I'm seeing online is that, bond yields are once again falling, showing that, okay, government spending, the bond markets are seemingly okay once again with this government spending. And I just think it risks the potential for the bond vigilantes to come back and enforce austerity on these governments, right? I mean,
but the question is, see, but are long yields coming down because people have confidence in bonds, or are long yields coming down because they're saying, oh man, a recession coming? but it's just a normal cycle. That's
Totally.
why long yields. And then if it turns into something that's uglier, then they shoot back up, right?
Yeah, no, I mean, I think that it just feels like it hasn't really sunk in, right? It's just like we just had a 40-year high in inflation, and people are saying, well, it wasn't, this is one side of the argument. It's not my view, but you hear one side of the argument saying, well, it was just a supply chain issue. It was a one-time thing. It really didn't have much to do with the government spending or the deficits. That spending and deficits, they were much needed because we were in a crisis. We were fighting a war against the virus, and it needed to be done. And as you can see now, inflation is back. It's coming back down. It's going to be at target sometime in 2024. And there's nothing to worry about in governments. Again, it's just, that's one side of the argument that I see frequently on Twitter from, I would say, people that have decent sized followings, and people are, where I get concerned is the general public gobbles this stuff up because they don't know any better, and they just think that, hey, free childcare, free dental care, it feels good. It's helping my cost of living. It's helping me live my life. But I would argue there's not really such thing as anything that's free. The money has to come from somewhere.
Of course, there's no free lunch. I mean, that's ultimately, I think. So can I just touch on some positives, which is, sort of bringing sort of, again, what you guys are both talking about. One is like, in a way, that Keith's point about how the whole world sort of dealing with this problem hides Canada's bad behavior. And I think that's like one of the sort of, it's like, if all your friends jumped off a bridge, would you do it too? It's like, that's a really terrible excuse and bad way to run a country. Just because your colleagues are doing something very stupid that's a terrible logical reasoning for why you should behave badly. And I think like him or hate him, I think the fact that Pierre Poilievre is sort of bringing this conversation forward, and I would argue trusting his audience. You know what I mean? Like, despite my nitpicking on sort of things here and there in the video, I think what he's doing is effectively saying this is a difficult conversation to have. This is a conversation we must have, and I'm going to trust the constituents to have a think about this difficult topic. And I think and then what I really didn't like from the responses was, instead of saying, I mean, I would never imagine anybody in political sphere to be magnanimous, but to just say like, okay, you're right. You know what? This is a difficult situation. This is a difficult subject. We don't agree with Pierre Poilievre on how we should solve the debt crisis, but it certainly is one. They just say, oh, no, it's not an issue. I mean, that's just bullshit. It is. It is. You can't describe that. I don't know, Keith. Maybe I'm too naive, but I was hoping for better.
No, I think you are absolutely correct. And people will, again, remove this. The world has just become so political, like, right, extremes and everything. Like, even at T-shirts, for God's sakes. Steve, you can wear a printed shirt sometimes. Like, it doesn't matter.
I only wear printed T-shirts at the Loonie Hour event.
That's right.
Oh my God, you did. Remember that gentleman from Winnipeg? He dropped us off at the event a year ago.
Twinkie shirt.
Yeah, that was really nice. I love that shirt. But again, like, people will say, well, what's the solution? You don't want to hear what the solution is. So the solution is, so let's jump back, 20 years ago when Canada last had this, debt problem. And, and again, like, back then, the Liberals were in power in Canada. They were in power after it broke. And the way people recognized it broke, because the Canadian dollar was headed to 50 cents in a hurry. It was, the Canadian dollar.
This was Jean Chrétien.
Yeah, absolutely. Yeah, and Paul Martin, would have been involved with helping it. And they said, you know what, we need to make some changes here. So they dramatically reduced spending. They raised taxes. All this austerity stuff that you read about and everything. And it was the Liberals. They did it. So again, this is a compliment, for that side. People think we only lean one way. That's not true. They forced Canada to take the medicine that they had to, and it worked. Okay, it worked back then, largely because the rest of the world was okay and was helping to go along with it. So the solution today, and again, I always laugh at this. I think you mentioned this before, Rich, and I always say, no, you're not right. It doesn't work this way. academic theory with all this debt problem is that, oh, you can inflate your way out of it. That's BS, right?
We
That's
disagree on that.
I disagree with your disagreement. That's a positive thing. Two
That
disagreements.
doesn't mean it. Anyway, keep going. Keep going.
How about this? You're stupid. How's that? But the reason I disagree with that thinking is because if you're able to inflate your way out of a debt problem, it would have happened already. Central banks try to create inflation for over a decade with zero, near zero, and QE and everything. They weren't able to do it. And then they do the very thing that caused inflation. They weren't expecting it to happen. The whole transitory talk. So, then by default, the only way to deal with this is that you're proactive. So here's a suggestion for everyone in Ottawa. And I'm going to be surprised if it happens. How about someone stand up on the floor and say, you know what? We have this problem. Everyone agrees with it. How about everyone here take a 25% pay cut? Same with our staffers and all that. We're going to take the lead. Hey, why not? Why not? You want to be a leader for your country? You do something like that, right? And
no, it's virtue signaling. It's the same reason why Canada cutting its emissions is bogus, because it doesn't. It's just that's like a virtual, it's a superficial gesture.
No, that's not. So cutting emissions, no one is taking a penalty for that.
Anyways, I don't want to get this distracted. I think that's a superficial thing. No,
but again, you gotta. Otherwise, it's, say, let's be dramatic, like Vivek Ramaswamy, everyone with their SIN number ending in an odd number works for the government. Your job is gone. We're going to cut spending by 50%. Like, you do all these things, which will bring down your debt and everything. And then, you deal with it that way. Or you get very creative and you do a debt for equity swap. And I don't think anyone is smart enough to put that together. So by default, we go back to the swampy clicker. What did you call it?
Damp squib. A swampy clicker is way better.
That's what we need.
But there's other. I mean, sorry, just ski before you. But there's other ways that. So one of the things you failed to mention, which I think is actually kind of delicious in a sense, because it's sort of against everything the Liberal Party stands for, is one of the reasons why Canada was able to lower its debt to GDP ratio. Do you want to take a wild guess what also happened at the exact same time that they started doing it? We had a massive commodity bubble. So from 2000 to 2008, commodity prices soared, all of them, basically all of them, maybe not all of them, but you know what I mean. And oil, for example, went up to $140, $120 a barrel. Canada is one of the largest producers of oil. Mind you, at that time, it was only producing maybe half as much as what we are now. But that massive injection of foreign capital in the form of investment, but also literally just profits and hard currency and taxes and royalties, etc., allowed Canada to... So that helped Canada fill its coffers. And so the irony right now is you have a situation where there's massive debts, both at the government side and the private side. We have very, very bad productivity growth as a function of our housing bubble and its bust. And the government of Canada is trying to destroy the one piece of the economy that continues to basically sustain this sort of fantasy that we are living in, which is the energy sector. And we've talked about this before. So I just think that the parallels, Keith, I think are really sort of interesting.
I think that's the good spot to kind of clean it up. But to your point, I mean, in terms of like austerity and cutting things, the reality is you're effectively partnered with Jagmeet Singh of the NDP. I mean, he's not going to be, I would argue that he's basically calling the final shots, and he's certainly not going to be saying, yeah, you know what, now's the time for cutting jobs and cutting social programs. So that's just never going to happen. And, we'll see what happens with the bond market and what happens with the global economy over the next, 18 to 24 months, because I think that's really going to be the telltale is, I think, Keith, again, I'm kind of curious your point, but I think the only way to really enforce austerity on Canada here is either going to be through, the currency, or through the bond market. Like the market is going to enforce austerity. It's not going to be the government willingly raising their hand and saying, let's be proactive.
Yeah, you're absolutely right. And so that's why, you often hear the expression, sometimes you just have to crash and burn. You go through it. But let's have a real quick go around if we have 30, 40 seconds. Rich, how do we inflate the economy to get out of that debt problem? I just want to go through I think people want to hear that conversation because we hear it all the time.
Inflate the debt away.
And I'm saying, hey, it's not going to work. And you're saying, hey, maybe it might work. So let's talk through that based on today's. Remember, and inflation comes from two ways. Well, three ways. It can come from, because of the currency, or by massive increase in demand or a massive decrease in supply. We just went through the holy grail where supply fell and demand increased, right? So how do we create this really strong economic growth where central banks are comfortable with it so that we're able to produce, we have more, global production, global GDP and everything. So people make more and able to pay down the debt. I don't know how we do it.
I don't care about, if we're talking about Canada specifically, and we're talking about nominal GDP growth, because that's what this debt is compared to. When you say debt to GDP, it's not debt to real GDP, it's debt to nominal GDP, right? So if your debt level is a certain level and your nominal GDP, well, how would you increase your nominal GDP? Well, you have inflation, and let's say I'll just concede to you, even though I think you're wrong. I'll concede to you that inflation is at 2%. If you have population growth at 3%, all of a sudden your nominal GDP growth is at 2%, and that's before you get out of bed. Leave aside any kind of productivity growth. So let's just say you have terrible productivity growth at 1%. So now you're at nominal GDP growth of 3%. Sorry, 6%, right? So you got 3% population. Now, remember, that 3% population growth is an outrageously high number. That's a 40-year high.
2% nominal GDP plus 3% population growth, 5% nominal GDP.
Right. So if you have a nominal GDP growth, so inflation plus population growth equals, let's say, 5 or 6, you have nominal GDP growth of 6%. That can deal with a lot of debt problems. Now, you might not like it. Now, certainly won't be good for the social cohesion of your economy. It certainly won't be good for the people at the lowest end of the income spectrum. But you want to deal with debt? That is one way that you can, to me, that is not at all sort of like a blue sky thinking. That we're seeing that happen right now.
Yeah, I mean, that's what people in the first 2 rows of the classroom think about. Let's go to the
what do you
back
mean? But that's happening right now.
Yeah, but it's not happening. So it is
what do you
happening.
Mean? We have 3%. We have 3% population growth, and we have 4%. Inflation.
But we're talking about a video. We're talking about a video with debt is out of control, right?
But so debt to GDP is flat over the last few years. That's
yeah. So how do we go into this coming year? We continue with 2-3% population growth. What happens with housing, Steve, on your side?
I'm not saying it's good.
If you continue to get 1 million people a year into the country,
yeah,
I think that you probably get what we continue to see, which is rents are incredibly sticky. Arguably, I would say, in my opinion, they'll still be inflating higher. And I think house prices, at least on a nominal basis, are flat or even up. Right.
Yeah.
I mean,
so
everyone's like, hey, right. I mean, like house prices nationally over the last, let's say, 18 months, 2 years, basically since rates started going up. I mean, they're down like maybe at most 10%. That's pretty crazy considering
that's my point. So if
mortgage rates have tripled.
Yeah, so housing, flies higher, and education, decreases in quality. Same with healthcare and all the EV plants and all that stuff. Again, like the solution that you just described, I think we've already been trying that. And maybe that's why population growth has been so strong in the Western world. Maybe they know this already, right? That's where they're headed.
Well, sorry, I'm interrupting, but don't confuse me giving you. I think it's a horrifically cynical way to solve this problem. Let's be very clear. You asked me for a solution, and I presented one.
Yeah. I'm not saying it's the rich solution.
Okay, good.
I'm just saying, come up with a reason why this, let's inflate the dead away story. It's there. But like sometimes we'll joke that, hey, like who's the captain of this ship out of Ottawa and elsewhere? And maybe there is. Maybe they do have this global plan put in place so that, but you grow it with, with population growth and, we'll have a few fires pop up, we'll deal with it. But I think though we still come back to this, this so-called, debt crisis that we are in. And again, my view is that I've always heard we're going to inflate the debt problem away, and it's never happened. It's never happened. So I'm going to be shocked that, they're going to be able to try to do that again. Because remember, right now, this, everyone believes that the Bank of Canada now is going to cut rates by 1 year from now. Rates are going to be 150 basis points lower.
Is that the market's at? Is that what the market's at right now?
Yeah, that's what I'm looking at right now.
I thought it was. I didn't realize it was that aggressive. I thought it was less than that.
So again, like this stuff doesn't reconcile. Like it just doesn't make sense. So again, the great thing with that is that we're having a conversation, and hopefully,
just to clarify, you're saying that under Rich's proposed solution or whatever. That you're going to have, let's say, 5% nominal GDP growth, right? So 2% GDP growth plus
2% inflation, 2% inflation plus population growth of 3%. Sorry.
Okay, so 5% nominal GDP, right? And so I guess, Keith, what you're saying is, okay, if you hypothetically had 5% nominal GDP growth, why on earth would the Bank of Canada be cutting rates by 150 basis points?
Yeah.
Because that's like, in the eyes of the BOC, that's a booming economy.
Again, that's what's hard to, and that's what we think about it all the time. You're saying, okay, I can see the path where we're going, what everyone hopes that we would go towards. The probability of success on that path, I think, is a lot lower than what everyone is hoping. And that's the way the conversation should be framed. It's not, it has to be this way or that way, or you put your hand over your ears and try to avoid it. We are going down this very odd path that we haven't experienced it before. Because again, I know we keep repeating ourselves, but it's the end of a 40-year cycle, and the 40-year cycle has been, accentuated by lower and lower rates and more debt. It's like the X, the X. I think the X crossed somewhere, Rich, maybe.
Yep, they do. Yeah,
something like that. Yeah. And, I think ultimately, and again, maybe there is this master plan. The Oasis, they have a song, the master plan. I don't know if it has anything to do with this, but it struck me just then. They wore solid shirts, Steve.
Smart.
Gallagher. Gallagher always had the long black. Wait, I got to say something. I was going to time with it. The master plan. The master plan. God damn it. I'm not a doctor, Jim.
Okay.
Actually, I am a doctor. Maybe this is where you need CBDC and UB at the end of the day. If that's the road we're going down, that's where we're going, guys.
Can I intervene quickly, Rich? Because this gets the point that you get this 5% nominal GDP growth. Obviously, the bond market has to begin to reprice, the yield curve. So bond yields naturally have to push higher. This comes back to the original sort of conversation or hypothesis that you do get some sort of financial repression of, it could be the central banks intervening, or it could be mandates from, let's say, the federal government that says, hey, you're a Canadian pension fund, you have to increase your allocation to government debt, federally issued government debt, to help us support because there's not enough demand to absorb yields, or we need to reprice, or we need to push yields lower to sustain this. So that comes back to the whole conversation of financial repression, which is governments stepping in and really trying to manage interest rates. And
Yeah, I mean,
By the
that's
way,
when you-
stage 2 or 3 of all this will be the government saying, by the way, 50% of your RSP has to buy federal debt.
I mean,
It's one thing to tell pension funds, like, defined benefit plans, you got to do it, but that again, that's the way, it goes. Social Security, for example, in the US, it all goes into the T-bonds, right? It's no difference.
Wasn't
But
that
that's where we could go, and that's where this could go. You don't want to hear that, do you? No one wants to hear
a
that.
logical conclusion.
I don't want to
Rich.
hear that. Tell me.
Well, I
What's
mean,
me,
that seems
sorry?
like a logical.
Yeah, I mean,
I'm
there's
not
other-
saying I'm advocating for it, but it seems like, wasn't
No,
Freeland out like what we talked about on the show like a month or two ago about saying, hey, maybe we should have the pension funds having a higher mandate to invest in Canadian equities, Canadian
That is such a
companies?
profoundly stupid idea. It's just crazy to me. It's just I don't understand how this person gets up out of bed. I find that, and we've talked about it before, but it is so dumb. But anyway, I
Rich,
think
it's rich. It's one leg at a time, just like you.
just like me. But I think the other thing is that what there's another sort of angle to this sort of, my sort of rose, my rosy tinted glasses version of how this could happen. The other thing is, so one of the things that Pierre Poilievre did well in this video is that he articulated what Reinhardt and Rogoff, who are two economists from the IMF, sort of outlined in their paper. Can't remember the name of the paper, but they said the four main indicators of the debt crisis are debt buildup, specifically in the private sector, check. Asset price inflation, particularly in housing, check. And he also said, and falling output, and then a large current account deficit. So let's leave large current account deficit for a second. But the other thing was the falling output. And that's the other side of this population growth piece, which we've been discussing for 2 years. It's nice of the CBC to join us, which is if you have falling per capita GDP, what is that? So the other side of having really terrible productivity growth is if you have falling output per capita. That's one of the sort of the precursors to a debt crisis. Now that this can happen because you're having a balance sheet recession and people cannot invest in productive assets. They have to pay for their home. They need to service their debt with every marginal dollar they accumulate. We're seeing that. We're seeing falling output because productivity growth is bad. We're also seeing that in Canada. And we're seeing falling output literally because there are more people and our GDP is stagnant. So our GDP per capita is also stagnant. The thing about that is that's not an appealing place for a country to be. So, in a sense, be careful what you wish for. That population growth jump that we see, Steve, you've made this point before, is like what happens if we get a significant pullback from that? All the stories of no housing, shitty jobs, blah, 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 finally leak out. And people say, you know what, I'm going to go to England or China or the US or whatever. And you have a significant retrenchment in that population growth. All of a sudden, these numbers no longer make sense. And the only thing holding up our economy is the current account balance. And they're doing everything in their power to screw that over.
Who's going to China?
Why not? I don't know. But
You,
does that make sense? I mean, like it could switch. It could switch.
No,
on us.
yeah, I'm just bugging you.
But you could fit in
okay.
if you go to Britain because you have the accent already.
Yeah,
You can
that's
fit
right.
right in.
Right, that's right.
It makes total sense. I mean, on the good news with all the EV mandates, we had gasoline usage demand hit an all-time record high in 2023. So, despite Mr. Guilbeault's attempts to get rid of gasoline and mandate electric vehicles across this country, gasoline demand hit a record high in 2023 and is poised to hit another record in 2024.
So that's global, right?
Global demand for gasoline.
Do you have the top line figure just to give people sort of an idea of what we do there?
Yep, it is
I think I
We
have it
are
too.
2023. So
I think it's like 100 and something, right? Million barrels.
27 million barrels a day.
How many? Sorry?
26.9 million barrels a day.
No, it's got to be higher than that. Are you sure? For the US or the global?
While consumption would recover this year, it wouldn't reach pre-pandemic levels. The outlook was for a gentle but constant downward trend. In the middle of the year, the IEA projected that gasoline usage would never return to 2019 levels when demand reached 26.7 million barrels a day. Instead, consumption rose to about 26.9 million barrels a day this year,
For the US.
according to the latest IEA figures.
Yeah, for the US. Crazy.
2024 is poised for another, even if small, increase to just above 27 million barrels a day.
So they didn't get the memo.
Rich, this is it says right, global demand for gasoline. It says
Really?
20, yeah, 27 million barrels a day.
Okay. All right. Okay,
Let's leave it there. We'll figure it out. We'll
figure it
someone-
out. Anyways, the point is it's
Rich,
going up.
Rich wants to split another hair. Let him do it next episode.
Uh, in
Rich, it doesn't matter.
2023
The number's gone up. That's all that matters.
I know. I'm sorry.
Okay, so gasoline demand benefits. The world in 2023, there were about 1.1 billion passenger cars in use, up from 850 million a decade earlier. So even if a growing number of those cars become battery powered, the absolute number of gasoline fueled cars continues to increase. A trend that will take decades rather than years to reverse. So, just the drop in the bucket of how many EVs we have here in Canada. But anyways, that's a good place to wrap it up. We don't want to ramble on. Happy New Year to all of our listeners. We appreciate your support here in 2023. We got a lot planned for 2024, including some fantastic guests coming up in the new year. We've got Jared Dillion of Street Freak, fantastic newsletter that I subscribe to. We've got Doomberg, the Green Chicken.
Oh, sweet.
Which is going to be an unbelievable interview. We're really looking forward to that. We've got Tian Yang of Variant Perception, leading global macro research company. Just so many good guests coming up down the pipe. We got some people in the agricultural space coming on, so we're going to get into what that means for the Canadian economy and many more. So we'll look forward to discussing that in the new year, and we'll see you again next week.